I like this photo of the American Union Bank in 1931 amidst a run. We saw it before in the chapter on the Great Depression. What I find so interesting is the sign for the bank, which is advertising 4% interest paid on what they called a thrift account. At the time, that was just another term for savings. For most of my adult life, a savings account with a regular commercial bank has typically only paid a tiny fraction of a percent interest, usually as low as 0.01%. How on earth was it that ordinary people were getting 4% interest on their savings? At that rate, you could double your money in just over 17 years. But after the Great Depression, Glass-Steagall had separated commercial and investment banking, and over the many decades since, the world of finance has changed quite a bit. If you want to earn something like 4% on your savings today, you need to take your money to an investment bank like Goldman Sachs. Starting in the 1980s, the freshwater economists had convinced policymakers to deregulate many industries, but among them was the financial industry, which started to see a rollback of the regulations placed on it after the Great Depression. By 1999, they had even repealed the parts of Glass-Steagall that separated commercial and investment banking. They weren't wrong. Deregulation led to a great deal of innovation in financial products, such as the mortgage-backed securities that helped manage risk levels efficiently and lower mortgage rates for everyday people. But that sort of risk pooling did not stop there. As we learned, the bottom tranches of these mortgage-backed securities conveyed the most risk. But that risk could also be pooled together, further reducing uncertainty. The lower-rated tranches of the mortgage-backed securities were pooled together into a new security called a collateralized debt obligation, or CDO for short. They basically work the same way as mortgage-backed securities. The money paid to the lower-rated tranches gets pooled together and then distributed to each tranche of the CDO in sequence. If one mortgage-backed security didn't pay out, it was okay because the CDO contained many dozens of them. So the people invested in the highest rated tranche of the CDO saw very little risk of not getting paid. The CDOs took a risky investment and turned it into a safe one. This is why mortgage rates kept falling. Everyone wants a nice, safe investment with low risk and a steady return. CDOs were rapidly expanding the supply of those safe investments, and investors had an insatiable appetite for them. Trillions of dollars were poured into these mortgage-backed securities and CDOs. But there are other ways to mitigate your risk. Say you're an investor and you're looking for a place to park your money and let it grow for a while. A collateralized debt obligation is a great investment for just that purpose. You invest your money, and each month you get a little payment from all the people who pay their mortgage. You can reinvest it, live off it, do whatever you want with it. All the while, your initial investment is safe in the value of the CDO. You can sell the CDO and get it all back if you wanted. But maybe you're worried that a wave of mortgage defaults means you'll lose your initial investment. You want to protect yourself from the potential downside of your investment. So you go to an insurance company and you take out an insurance policy on it. That insurance policy is called credit default swaps. Essentially, you agree to make small monthly payments or premiums to the insurance company. In exchange, if your investment ever does go under and you lose it all, then the credit default swap will pay out and you'll get your money back. It's just like any other insurance policy. They actually became so common, people started buying these swaps even if they didn't own a CDO. They were just gambling on the possibility that the CDOs could go bust. All of this should be fine. It all sounds crazy, but this world of high finance is truly awesome. These innovations are complicated and you need advanced math degrees to even begin to calculate the risk. But they're absolutely worth it in the end because they help drive our economy to greater prosperity through investment. Unfortunately, not everyone involved was a math wizard, and some financial institutions were making really big mistakes. The problem was a disregard for correlated risk. You can buy insurance in case your house burns down. Insurance gives people peace of mind and lets them offload some of the risk they face in their life onto an insurance company. Insurance companies are able to provide this insurance because they can sell lots of policies and pool the risk together. Fires that burn down houses are basically random events. Every individual homeowner might face, say, a 1% risk of their house burning down each year, which is a big risk for an individual to take with something so valuable. But if an insurance company insures millions of homes, the law of large numbers guarantees that only about 1% of them will burn down, and the insurance company can charge appropriate premiums to make sure they bring in enough money to pay out on 1% of their policies each year. But that assumes that if my house burns down, it doesn't change the probability that your house will burn down. That isn't always true. People who live in places prone to wildfires have a difficult time getting insurance because risk pooling doesn't work in this circumstance. There may only be a 1% chance of a wildfire, but if that 1% chance does happen, everyone's house burns down, not just 1% of homes. The insurance company would have to pay out everyone's policy all at the same time, and there's no way to make that profitable. The people creating collateralized debt obligations and credit default swaps were assuming that the risk of default on mortgages was independent. They didn't account for the possibility that something might happen that would make significantly more people default on their mortgage, and that would prove to be their fatal error. In fairness, quite a few people saw the disaster coming, and many of them bet big on potential collapse, making billions of dollars as financial markets collapsed in 2008. But no one wanted to listen to them. Investment banking was in a golden age. Between 2002 and 2007, total revenue for investment banking doubled from $100 billion to over $200 billion. But these investment banks were essentially operating in the shadows. Investment banks are not part of the Federal Reserve System. Even though they essentially take in deposits and make investments with them, just like a regular bank, there are no reserve requirements, no deposit insurance, no safeguards against runs. All the protections put in place after the Great Depression just didn't apply to these investment banks. And a perfect storm was about to threaten the whole thing.